A March snowstorm, higher gas prices, and we thought, why not talk about taxes today? Seems fitting, all this terrible news for everybody out there. Thanks so much for joining us once again on the Roundtable program. Glad to have with us in this segment Alan Lancz. He is our local money man who we go to on Ask the Expert every other week here on 13 ABC Action News at noon. Alan, good to see you.
Good to see you, Jeff.
Let's talk a little bit. We heard what Mr. Botkin was saying earlier in talking about some of the pitfalls of taxes and what you should think about when it comes to your money. I wanted to bring you on here today to talk a little bit about that change in mentality that exists right now when it comes to saving, to putting away, because as we talked about in the break, I said, it was drilled into my head, it was drilled into my parents' heads about putting your money in CDs, putting your money in a savings account. But that's not the route anymore, is it?
No, I think, back then, in our parents' day, you had pension plans and, the employer would really, supply your retirement. And then what you did with the extra money, your discretionary money, you put, like you said, in passbooks or CDs. Mm-hmm. Because interest rates have dropped so much and we're artificially keeping them low to try to help this economy, in 1980, the average 6-month CD was 17%.
Yeah, take a look. In fact, we can show that graphic to people at home. Take a look at those CD month rates. Talk through these numbers. It's when you put it down on paper, I mean, you can talk about it in the realm of your mind and think, yeah, I can see the decline. But you look at it, Alan, it's unbelievable.
Oh, it is. It is. And you could get 4.5%, 5%, 5-6 years ago, and now, you can get 0.25%. If you negotiate, shop around, you can get a little bit higher. A 1/4%, which is just incredible compared to, just 5 years ago. So, and then the other big change, Jeff, has been that you're supplying your own 401k now, mm-hmm. your own retirement. So you don't get that pension, you don't get that defined, contribution where you're going to get X amount upon retirement every month. And because of those two things, our focus on savings and investing is totally different than it was 20 years ago.
For people who, we talk about it quite frequently, but when you mentioned the fact these interest rates, they were high in the 80s, they were lower the last couple of years, dropping below 1%. That is by design. You said, as far as getting this economy back and going. Why is that? Why do they do that?
Well, I mean, if interest rates are higher, it's going to cost more to borrow, and it's not going to stimulate the economy. So one of the things with the, as far as financial crisis in 2008 was to bring down interest rates, and because the recovery hasn't been as strong as it typically is, we've kept interest rates artificially depressed. So that's really hurt the retirees, the savers, as we're talking about.
Right.
There's some options you can do. You can negotiate a CD rate. I mean, we're getting 1 to 3% for short-term CDs. If you go further out, we can get 4 to 5%.
Let's talk about that a little further. We're bringing up 5 points in what savers should do at this point. If you're in that generation where no, the CDs, the savings, or I'm sorry, the CDs and the savings aren't an option anymore. You need to go another route. But you're saying they're negotiable. Go into that a little bit more.
Yeah, a bank will have a set standard stated rate. If you're a customer of that bank, many times you'll get quite a bit more. And where it sounds like the average CD is 1/4% for 6 months now, mm-hmm. they might double that. And so you're getting.
If you're a member of that bank, you're saying?
Exactly. They as far as appreciate your business, etc. Other banks are looking to add to their capital reserve. Those banks, they're paying 1%. So again, if you look around, if you shop around, make sure you're under the 250,000 FDIC, so it's safe. Mm-hmm. But you can get much, higher rates. That's 4 times more than if you just went to the bank.
Number 2, you said check out very short-term bonds.
Yeah, I mean preferred stocks, bonds. If the backer is safe, like we just bought a General Electric at 19. It matures at 25 and it yields 4.7%. Mm-hmm. So instead of buying a 10-year treasury, Jeff, where you're getting 2.74 and that's all you're going to get for those 10 years, if interest rates go up, you're going to lose principal. On something like this, you can get some appreciation where it goes from 19 to the par value of 25. So things like that, or Vanguard has low-cost short-term bonds. If interest rates go up, you're going to lose money, so don't go into long-term bonds right now.
Real estate market's turning a bit. You point that out as well, stocks and real estate.
Well, that's what's happened. Real estate and stocks have really, last year was phenomenal for both areas, and it's because some of these savers, retirees are getting forced because even 1%, 2% on a CD is not enough, for them to survive. So they're kind of getting forced into the stock market, and that's the concern. Is it artificially inflating, both stocks and real estate? If you go into real estate or stocks, have a long-term perspective, and then look at the cost and the risk involved. Know what your downside is before you invest. But that's where a lot of the money is going, as opposed to money markets and CDs.
Yeah, you talk about getting rid of debt and how important that is.
Well, that's a big thing. We had a couple that's close to retiring in this week, and the big question was they were going to get their Social Security now at 62, and if they waited and they've got other money, they'll get an 8% increase for every year they wait. So, if you're getting 1-2% on your CDs and you can get 8% guaranteed by waiting till 65, 66, for your Social Security, that's great. Also, if you have debt, credit card debt, you might be paying 10, 12%. Paying that off, that's a guaranteed 12% that you're making that you would have paid.
What'd they decide?
Oh, they decided to wait because they had the money, elsewhere. So it just makes a lot of sense.
You point out tax implications, and tax implications must be considered to get a net return on your investment. Explain that a little bit.
Well, that's a big deal in that, in the real estate and in stocks, you can defer, hold it for a year, and then you get capital gains treatment, so you're not as far as paying like ordinary income. If it's a CD or interest-bearing bond, what you might want to do is put those in your 401k, if it has a high yield like we were talking about with the GE preferred, because then if you're getting 4, 5, 6%, you don't pay taxes on it. So look at it from, if something's tax efficient, keep it outside of your retirement. Keep it individually, like your personal savings, your personal investment plan. If something is not tax efficient, like bonds or international investments, things like that, try to keep it within that 401k.
Got about a minute left. Sandy Botkin, our first guest, and you were listening to some of what he was saying. He said tax return or tax refund, not necessarily a good thing. What do you do? What do you change if you think to yourself, okay, maybe I shouldn't be getting this much of a refund?
Yeah, I think you just adjust as far as your declared deductions and maybe itemize differently. If you're doing quarterly estimates, you can adjust that. But if you're getting a big refund, you're basically giving an interest-free loan to the government. So unless you're not disciplined enough to force your savings throughout the year, it really doesn't make that much sense.
And probably a good idea, and I know we've said it before, once again and again on 13 ABC Action News at noon, is be disciplined. Make sure you can set aside that money during the course of the year, because at the end of the year, obviously, is where the payoff comes.
And that's a big deal with any investment. Buy, when things are down. It's really hard to, and then take profits when things are starting to look up. Take profits then.
Alan, we appreciate it. As always, good to see you. We'll see you again on 13 ABC Action News at noon.
Sounds real good.
All right, stay right there. We wrap things up for this Sunday.